Thank you. Good afternoon to all of you. Today, being its sixth class on financial services. Today, on being a sixth class on financial services, I hope all the students might be knowing about that. This is the last class about for this particular subject course. If you have any doubts, always welcome. If you are be participating in that, always welcome. And then from the last 5 classes, in the first spell 3 classes and the second spell 3 classes. So in the last 6 classes, we are constantly discussing about the various financial services, various financial intermediaries, then financial services, financial sector, and various other terminologies. And the subject basically covering about the various financial services that are offered by the various financial intermediaries and which are a part of financial system, and how best the funds are mobilized from the savers to the borrowers. How best the funds are mobilized from the persons who are ready to invest and from the persons who are ready to borrow. So actually here in the last class, being it's a last class, I want to tell you about a brief explanation about this one. Every individual will have his own income. Whenever the income is sufficient enough, then definitely he will be able to save some amount. Savings is the excess of income over the expenditure. The savings kept idle, that will not result in any return to the person. If they put their money in any of the investment opportunity, that is like shares or fixed deposits, bonds, golds, real estate, etc., etc. This is said to be investment. When savings are turned over into investment, definitely there will be a return amount, that is RETU, or a return amount on that. Suppose if you deposited money in the fixed deposit, you will be able to earn interest from the bank. So in such a way, if you invest in the share market, you will be able to get amount of dividend. As you are commerce students, it is well known to you. Then if you are able to invest in the bonds, you will be able to have, just 1 second. Thank you. Sure. 21st, 23. When all the financial services that comes under commercial banks plays a greater role. Along with the commercial banks, various other financial institutions also will participate in that. Various mutual fund trusts, then it comes under investment trusts, and so on. So actually, as we have discussed about all the elements on that, all the financial services are subdivided into 2 parts, mostly maximum number of financial services are subdivided in 2 parts. They are fund-based financial services and fee-based financial services. You might be thinking about, I am rotating this topic always because all the financial services that comes under either any one of this umbrella, that is either fund-based or fees-based financial services. Fund-based, as I told you, all the venture capital financing, all the working capital management financing, all this will come under the fund-based. Then when we talk about fee-based financial services, when underwriting of shares, lease financing, that is lease financing, all these subcontents are there, loan syndication. This will come under that particular process. When we are talking about the fees-based financial services, and then we have discussed about the other aspects relating to factorization, then forfeitation, debt securitization, all this will come under financial services that are major part of the fees-based financial services. To be frank, fund-based financial services, they involve transfer of physical money, whereas in case of fees-based financial services, certain amount of fees is charged by the service provider, and the facilitation is made about a facility is given to the borrower. So these are the various important aspects. For example, factoring. In case of factoring, it is purchasing of the book debts of the seller, and finally, he is arranging the finance against the book debts created. In that particular manner, we have discussed about the various fund-based and fees-based financial services in simple. Then we have already talked about the leasing finances, hire purchase financing, and venture capital financing. Then factorization, forfeiting, and securitization of the debt, and this one. So coming to the leasing, already as I told you, it is an agreement basis, lessor, lessee, and to use a particular asset for the purpose of making some generation of an income, for the purpose of generating income, the leasing is used. So in the case of leasing, lessee, lessor, lease agreement are the three important parts. This lease financing is basically used for the purpose of extraction of the minerals and other aspects. This is already discussed. Then hire purchase. In case of hire purchase system, the hire vendor will buy an asset. That means he is the owner of the asset, and that asset is that asset will be transferred to the hire buyer, hire purchaser, after paying of all the installments to them. So in the case of hire purchase system, asset is transferred to the hire vendor on the last payment, on the receipt of the last payment by the hire vendor. Then finally, the asset will be acquired by the hire purchaser. Then this is governed by the hire purchase agreement. So another part of hire purchase agreement, hire purchase system is installment purchase system. Both almost will travel on the same lines, but installment purchase system, in that asset ownership will not be there when once the installment agreement is committed. Then coming to the venture capital financing. In the case of venture capital financing, as the name itself we say, venture capital is a high risk capital which is provided by the venture capitalist to the borrower. So if venture, already this word venture is mostly used in case of real estate business aspect. So they will invest crores of rupees, and when they will realize the money or how much amount of money that will come as a part of the profit, that is unknown. If it is success, it will be crores of rupees profit. If it is failure, entire things will go on. For example, research and development projects also will come under the venture capital financing only. In case of research and development, if the research is success, then the product whichever produced is released into the market, and the manufacturer can make out excellent profits out of that. These are the other important aspects in this. Then when whatever we are talking about this venture capital, then we have understood about the various aspects relating to the factorization. Then what is the factorization? Already we have what is factorization? Already we have understood now just itself. So when we are talking about factorization, anybody who is selling the goods on the basis of the credit, then the collection of the book debts is an important problem for them. So when we are talking about collection of the book debts, factory will undertake. So the process of factorization takes place that when the factorer, when the seller, when the buyer agrees upon the mutual agreement on that. So whenever somebody joined and left. When the factorer will provide the basis for the purchase of the asset. So the buyer will approach, the seller will definitely send the note, and the buyer intention to simple factor, and on basing on the factor and buyer discussing about the credit limit, then seller will supply the material or any other asset or something. Then finally, the factorer is liable to give 80 to 85% of the amount to the seller in advance. So then whatever the money received from the buyer, that will go to the factorer at the end of that. So in simple language, factoring is a process of arranging the finance to the seller who is selling the goods on credit from the buyer against the debt, whatever raised by that. Then forfeiting. The forfeiting process is nothing but wherever the cross-border sales is there, that bills will be settled by the factor, the forfeiter. Then securitization of the debt. When we are talking about securitization of debt, sometimes debts will become a long-range debt. Then, so say frankly speaking, illiquid assets, some assets which are not liquid, which cannot be converted to cash easily, they will be converted to cash, liquid cash assets by means of securitization of the debt. So this is all about some of the services. And next, coming to the yesterday's aspect in that, when we are talking about investment of funds, then investment trusts and mutual funds. This is the block 4, investment trusts and mutual funds. So we have discussed broadly about investment trusts. Investment trust is basically provided to give the various aspects, give financing, pool up of financing from the various sources, and then that money is invested in the various types of securities, basically long-term securities. Then out of the pooled resources, they will invest in the form of shares, bonds, debentures, and so on, which are basically long-term in nature. And whatever the returns that are gained by the investment trust, they will be shared among the various unit holders. Just like in Unit Trust of India, unit trust, that is mutual funds, the investment trusts also will have unit-based mechanism. So actually, in the case of investment funds, investment trust, in the case of investment trust, the assets like stocks, bonds, debentures are purchased, and whatever the return that is arising out of this particular purchase, it will be transferred to the investors. Then, what is the difference between unit trust and investment trust is discussed in the previous class. Then close-ended. Investment trust is a close-ended, where an issue is fixed on the numbers of shares and trading is possible only in the stock exchange. Whereas this is on the case of unit trust. This is open-ended trusts are there, and issue and redemption is possible as and when. That is why we call it as investment trusts are not much liquid as in case of the unit trusts. Fixed amount of money is available to the investment trust, whereas floating amount is only available to the unit trust. Because unit trust at any time, the investor can withdraw the money by selling the units to someone else. Due to this, investment trusts have flexibility. They cannot make it up to any sort of other investment opportunities. To meet the investor's demand, fund managers in the case of mutual funds sell the fixed assets at the lower rate also sometimes. This is the important problem that is the mutual fund. Investment trust functions in a more volatile manner, whereas whereas unit trusts, they will operate in a stable manner. These are the various differences in that. Basically, two types of investment trusts are operating in India. One is the real estate investment trust. Second is infrastructure investment trust. Real estate investment trust pool the money from the small savers, and it launches a fund, and a sum of the money that is retail investors, institutions, investment that money, and the real estate sector on behalf of them who do not directly able to invest, who are not directly able to invest in the real estate assets, they can invest their money in the real estate investment funds, investment trust. So due to this, whenever there is a investment is made, the real estate investment trusts basically invest in the form of commercial complex, holding properties in the commercial complex, and developing properties in the commercial complex and all, and which are mostly real estate. One. Then, as a return to the investor, the rental income is given to the investors. So, three types of real estate investments are discussed in the class. Equity real estates, where the purchase, own, and manage income generation properties. They only will buy, they only generate income, and they only take. Then, when you are talking about second one, that is mortgage real estate investment trust. So, here, in the case of mortgage investment trust, which lend money to the real estate owners, either directly or indirectly. Then, hybrid method is there where both the ownership as well as the lending will be there in the case of real estate investment. This is the most important question. Why explain the concept of a real estate investment trust. And then we have studied about investment trust, the infrastructure investment trust, where investments are made in the various infrastructure projects. What are infrastructure projects? That is construction of telecom power supply, telecom units, power plants, infrastructure facilities, roads, highways, etc., and so on. This is normally a longer gestation period, say 10 years or more. So, in this process, the assets are relating to the normally a longer gestation period. The primary objective of investment trust is to promote investment in the infrastructure projects, basically. So, here, even though it is more largely dependent on the infrastructure success, but investment trusts in this infrastructure sector will have a lot of profits in nowadays. So these are the very important aspects. So explain the types of investment trusts. This is a major important question that is normally you have to undergo on that. So management of investment trusts, this is already we have given. So two types of managements are there: active management of investment trust, passive management of investment trust. When an investment trust is actively involved in participating in the various buying and selling activities, that is called active management strategy. Then second one is passive management strategy, that is just simply buying and keeping quiet, and depending on the Sensex and other indexes, then it is called as passive management. Then top-down approach, bottom-up approach. So explain various management strategies of investment trusts. That is a very, very essential point you have to remember. Then, as a lastly, we have discussed about the mutual funds. So actually, this mutual fund is mostly known to all of us. This is generally where the investors also may be there. Mutual fund is a pooling of various resources from the small investors. Frankly speaking, 10 rupees onwards also, there is a possibility to invest. Then minimum 5,000 rupees investment will be there. And each amount is divided into units, and unit value is decided on the basis of the net asset value. What is NAV? Net asset value. Write a short note on the NAV. This type of questions normally you may be able to understand. So net asset value is the market price at which each unit of a particular scheme in relation to the assets is calculated. So how it can be calculated? So this is calculated, net asset value is calculated on the basis of the balance sheet. Already you know, on the right side of the balance sheet, total assets. On the left-hand side of the balance sheet, liabilities will be there, and current liabilities and expenses are subtracted from the total assets, and then divide with from the total assets, and then divide with the total number of units. That means total assets minus current liabilities and expenses by total number of units. This is page number 147. Page number 147, para number 11.2. That is very, very important aspect in that. So now, after understanding the meaning of mutual funds, how these mutual funds are different from the equity share. This is a general important question which may be there in there. This is given paragraph number 11.3 in the textbook, page number 147, which is a material to you. So mutual funds, how it is different from the equity funds, equity shares. So mutual funds are basically, they are diversified in nature. So when 10 rupees onwards, say for example, mutual funds pooling of the resources, 100 people invested 5,000 rupees each, then 50 lakhs will come. So that 50 lakhs is diversified in the various sectors of the shares, not only single share. So the money is diversified into the various sectors, and any sector may be profitable. That profits will be generated by the unit trust investors. Whereas in case of equity share investment, diversification is a less. Diversification does not happen. Maximum you can diversify between the various shares of the companies only, not various other type of investment opportunity. Then coming to the mutual funds are sold in the form of the units to the unit holders, which are not concerned with the growth of the company. Here we are not worried about the growth of the company because fund managers are there separately to manage your mutual fund. But in case of the equity share, investor, he himself has to manage the investment and he can take advice, but fund manager separately will not be there. Capital risk is very much minimum in case of mutual funds, whereas capital risk is very, very high in case of share market investments. That is all the various differences are there. Mutual funds involve the various charges like exit load and entry load, various expenses ratios also will be there. But in case of equity shares, brokerage charges will be there in that. So these are the various aspects that we have to understand in that. Then para 11.4 is talking about the advantages of mutual funds. This is a very standard question and important aspect what a student is expected to learn. So explain the importance of mutual funds. So in the case of this is para 11.4 in the material book, page number 148. So mutual funds basically diversified in the nature. They are diversified in nature. As I told you, mutual fund investments are very much diversified. Then low transaction cost of operation is very low, and availability of various schemes are there. Then professional management is there in case of that. Liquidity is there at any time after the lock-in period. Anybody can sell and anybody can buy these type of units. And tax benefits is there. Then well arranged and transparency, flexibility, and all these aspects are the last most important aspect in that is types of mutual funds. So actually mutual funds are by nature, they are segregated into two aspects, that is by structure, by investment objective, and special schemes. By structure, that is open-ended schemes, close-ended schemes. If entry and exit are free, then it is called as an open-ended form. Key feature of open-ended schemes is very much of liquidity. At any time you can enter into at any time means there will be some locking periods, conditions will be there. It is not condition free. It is not condition free. So at any point of time, because continuous market operations are provided and continuous market operations are provided just like in the when we are talking about the open-ended fund basically entry and exit are there, and then close-ended fund. Then once the mutual fund is open, every investor is required to buy, and after a particular date, mutual fund will close. The option is closed, and you cannot buy. And hybrid systems are also there. That is called as interval schemes. After some time, they will reopen. Sometimes they will close, like the differences. On the basis of investment objective, the schemes are subdivided into various schemes. That is, one is growth scheme, and investment is done on the basis of the growth scheme. Only growth is considered in the investment, but the income will not be given in a partial manner. Second is income schemes. Then higher amount of concentration is on income provision. And then balanced schemes, they will provide both growth as well as income. And money market schemes also are provided. And special schemes in respect of the tax savings is provided. If you invest in some of the mutual fund investment, you will be eligible for the tax exemption. And indexed schemes, structural bonds, these are some of the other types of the monthly income plans, gift bonds and all, high yield debts, fixed maturity plans. These are various schemes. N number of schemes are there in the case of the mutual funds. These are the very, very important aspect in this. And types of risk to the investor, that is market risk, inflation risk, credit risk. Explain the various types of risk associated with the mutual fund. This is a general question, page number 156, that you can refer for that. Now, Let us proceed to the unit number 12. Okay, ignore. Then unit number 13. In the case of unit number 13, merchant banking. What is merchant banking? How the merchant banking is helpful? All these things let us discuss in this particular class right now. Just 1 second. Step 3. When we are talking about the merchant banking, exactly what is merchant banking? How the merchant banking operations goes on, all these aspects now we are able to understand in this particular. All these aspects will be understood in this particular class. So actually, what is commercial banks we know well. So what is the main objective of commercial banks? If you understand, then we can extend our discussion towards merchant banking aspect. But this unit number, block number 5, every student is expected to go through. Basically, in the questions, answers also, they are very liberal. Unit number 13 and unit number 14 are most important. What is credit rating, what is merchant banking and all. So in the case of block 5, unit number 13, merchant banking. So what, if you know about commercial banks, then it is easy for you to understand about the merchant banking. Commercial banks basically have an important function of providing, of accepting the deposits from the general public and at the same time they will have a process of lending to the needy person. So commercial banks basically they are basically intended to provide the loans they are intended to provide the loans and they accept the deposits. The primary objective of every commercial bank, the banking itself is known as accepting deposits and lending money to the needy person. They will act as a mediator between the person who is having sufficient money and they will act as a service provider in the form of loan. But what is the important aspect in the case of merchant banking? Actually, there is no specific definition about what is a merchant bank in anywhere else. So merchant banking is a part of banking system. So every commercial bank will nowadays is doing merchant banking services. Merchant banking is basically a service providing. So skill-oriented professional services are provided by the merchant banking operations. So how to understand about this one is that every commercial bank will provide the almost all merchant banking services. Merchant banking can be understood as a skill-oriented professional services, which are provided by the merchant banks to their clients concerning their financial needs and adequate consideration in the form of fees. So every commercial bank will provide merchant banking services against a particular fees. What are merchant banking services again? They are skill-oriented professional services. For example, whether to invest in a particular stock market operations or not. Which stocks can be suggested? In the State Bank of India, there is a separate wing is there. That is State Bank of India. A separate wing is there which provide the merchant banking services like issue management services. They are providing leasing finance. They are providing high purchase arrangements also. So like car loans, etc. They are also financing themselves. These are all comes under the financial home loans and all. So when we talk about the merchant bank system, what you can understand is that any skill-based professional service that is provided against a fees base that is said to be a merchant banking operation. Now, what is basically the difference between a commercial bank and what is basically a difference between the commercial bank and a merchant bank? So, but as I told you, every commercial bank is providing merchant banking services, but at the same time, there are certain differences also there between the merchant banking and commercial banking operations. To understand about commercial banking is basically established by a number of people providing the basic banking functions. You can refer to the paragraph number 13.3, page number 176 of your material, which is a very, very important question. So, commercial banking, they are accepting deposits and lending money to the general public is the primary objective of a commercial bank. Whereas in case of merchant banking, they provide specialized services both at the national and international level, and services are the main criteria for a merchant banking operation. So, what is the regulatory body in case of commercial banks and merchant bank? In case of commercial bank, the main regulatory body is the Reserve Bank of India, whereas they are extremely sorry. The banks are mostly controlled by the regulated by the Banking Regulation Act of 1949, and under the guidance of the Reserve Bank of India, the commercial banks will always work. And in case of merchant banking services, rules and regulations are framed by the Securities Exchange Board of India, SEBI, and all the rules are binding upon the merchant banking operations. And engaged in the commercial banks are highly engaged in the general banking business. Like general banking business means providing loans, accepting deposits, and so on. Whereas in case of merchant banking division, the consultancy type operations will be there. Consultancy operations are provided. Loan is extended on the debit or debt orientation to the buyer. That is why we known as a debtor-creditor relationship. What is a banker-customer relationship? It is a debtor-creditor relationship, as you know well. So, but in case of the merchant banking, there are equity-related issues will be there in that. And risk will be less in case of the commercial banking, whereas risk will be high in case of the merchant banking operations. In the case of commercial banks, he is a financier, that means providing finance to the public. Whereas merchant banking is only a finance advisor. He don't provide finance. He will provide advice to that extent. So needs of general public are categorized by the commercial banks, whereas needs of corporate firms and only very few types of financial institutions are provided by the merchant banking. These are the importance of this. Next. What are the various important services that are provided by the merchant banking operations in this? So actually this is the most important question. Explain the various services of merchant banking operations in that. Okay. The various services that are provided, this is given in para number 13.4, page numbers 176. I have listed only few, but a long list is given in the material book, and nearly 18 services are provided. Out of the 18 services, if you are able to remember and able to reproduce for the examination point of view, nearly 10 to 12, if your student is expected to remember and write, the more important elements only you have to understand and write. So first give a reading in the book. Out of that, which you are able to remember, which you are able to understand clearly, on that aspects you concentrate more on the examination point of view, right? So arranging working capital finance, that is the first important one. Actually, working capital is a capital that is required for day-to-day operations of the business, as we know. But arranging of working capital is also actually fund-based aspect. But normally it is not included by the included in the merchant banking operation. But recently, Canara Bank, Grindlays Bank, Central Bank of India, they included this. This working capital financing is also a part of the merchant banking services area. So providing working capital is also comes under services of merchant banking. Then broker in the stock exchange, they will buy and sell the shares. Merchant banks act as a broker in the stock exchange. They will buy the shares, they will sell the shares also. To conduct research on equity shares, they also advise their clients about which shares are to be purchased, which shares give more amount of return, and so on and so forth. Venture capital investment, banking operations are also done by the merchant banking services. Next, third point is that capital restructuring. I noted only a few points and I am explaining almost all. Capital restructuring services. So sometimes companies, they will try to structure their capital in a different manner. Then also the restructuring of the capital services, that is debt equity mixture. Capital structure refers to the debt equity mixture. How much is the debt? How much is the equity? That mixture is considered in that. Then corporate counseling. That corporate counseling is basically providing the expert opinion or suggestions, detailed analysis about corporate laws and applicable to the business unit is provided. The areas of corporate counseling include guidance to the corporate units on the areas of diversification, market, making a detailed market analysis, and so on. Then issue management. Issue management is already covered so many times in the previous classes also. So managing the issue of fresh capital, that is either initial public offer, IPO, or about remaining offer or subsequent offers, either right issue or bonus issue, or all these issues are managed by the merchant banking operation. Lease services, this is already explained. Loan syndication, it's already done. Management of interest and dividend also is done by the merchant banking. Money market operations. What are money market operations? That is short-term financial operations that are provided. So underwriting of shares, when a particular subscription, when a particular company is not able to gain substantial support from the market, then these underwriters will help us to provide. Then in the same way, offshore financing, portfolio management. Merchant banking services provide. What is a portfolio? This is the most important element. Portfolio is a combination of various securities. In case a company or a fund which is comprising of various two, three companies, whether that is considered as a portfolio. Services to the public sector units, special assistance to MSMEs, nowadays micro, small and medium enterprises, all these aspects are coming forward. And lastly, venture capital is also, as I told you, this comes under the merchant banking operations only. These are the various broadly I have explained, and refer to page number 13. Paragraph number 13.4, page number 176. So this is a very, very important element in that. Then problems of merchant bank also there. That is comes under high capital adequacy norms. 1 crore rupees must be there with to provide 1 crore rupees must be deposited for the purpose of SEBI guidelines and securitization of the merchant banks. And small professional bankers, they will not be able to, small and professional bankers, they will not be able to put this much of 1 crore rupees on that. There are so many restrictions are there on the merchant banking operations by SEBI. Then non-cooperating of issue companies. Sometimes issuing companies, they do not cooperate with the merchant banking, because when once merchant banking operations start, they are influenced more on the issue management practices. So these are the various aspects of the merchant banking. I hope you are able to understand in this one. Unit number 14, that is credit rating. When we talk about credit rating process, actually, what is credit rating? What is the importance of credit rating that we will discuss? In the last 10 minutes, we will discuss about what are the various topics that are most to be given concentration and so on and so forth. Actually, what is credit rating? Whenever a new financial product that comes into the market, let us say a new company is issuing shares or it is issuing bonds, or at the same time, a new venture capital fund is coming out, or any other financial instruments coming out, like commercial papers and all. Then in such a case, every investor will have a doubt. Shall I invest in that? If I invest, shall I get back my money properly? Shall I get invest interest properly? And all. So in this particular process, somebody should say that yes, this fund is correct, or this fund is good. Yes, this share is good to invest. Like that, if somebody is able to rate or rank, then the investor will be peaceful on that. This type of process is done, whatever the process that is done, that is called as a credit rating. So credit rating is the process of judging the acceptability of a financial product. It is not, clearly you understand, it is not the process of rating the organization, but it is the process of rating the financial instrument itself. That's all. Or specific security itself, not the entire company as a whole. So the credit rating, para 14.2, page number 185, it is clearly explained in this. It is an expert opinion by a rating agency on the relative willingness and ability of issuer of a debt instrument to meet the debt servicing obligations in time and in full. So how far a issuer, that is, say for example, a commercial paper which is issued by a company, or for example, a bond is issued by a company, public limited company, bonds are issued. So how far this bond is worth to buy? Second one, how far the company is able to repay your money properly? Third one, how far the company is able to pay the interest on this bond, and so on and so forth. Like that, the expert opinion on these aspects, how far the issuer of the bond is able to pay the amount whatever invested by the investor. Here bond is issued by the company, bond is purchased by the general public. Suppose if I purchase the bond, I will put my money and I will purchase a bond just like a share. And money will go from me to the company, and the company will issue a bond paper to me. On the bond, there is a specific interest rate and all. So whether to purchase, worth to purchase this bond or not, that is to be decided. Then CRISIL, CRISIL, whenever we are talking about credit rating, every time that is credit rating institution that will be run, it is defined the credit rating as an unbiased independent opinion as to issuer's capacity to meet financial obligations. Unbiased and independent opinion so as to issuer's capacity to meet the financial obligation. What are financial obligations? Repay the money to the investor and providing return on that, either interest or something extra to that. It does not constitute any recommendations to buy or sell. The credit rating agency will never say to buy, will never say to sell. But it says that what is the expert opinion on that? Whether the issuer can pay the principal amount or not, whether the issuer can go with the other aspects or not. Then coming to the ICRA definition, that is also similar. Ratings are the opinions of the relative capability of the timely servicing of the corporate debt and obligations. These are not recommendations to buy or sell, neither accuracy nor the completeness of the information is guaranteed. Credit rating information is only regarding the credit worthiness or suggestion only, but it does not say any other things on that. So importance of credit rating, this is a very, very aspect on this. Credit rating establishes a link between, this is paragraph number 14.3, paragraph number 14.3. Credit rating establishes a link between the risk and return. So how much is the risk? How much will be the return? That is established by the credit rating agency. Importance of credit rating to the lender. So whoever person lending, that is also, frankly speaking, here we can say that I am lending to the company. That is, I am a lender. Company is a receiver, I am a lender. So lender will be satisfied if the credit rating is higher and higher. Importance of credit rating for the borrowing companies also. Borrowing companies also enjoy so much of demand for their financial products if the credit rating is higher. These are the various important aspects that you have to understand about the 14.4. What is the nature of the credit rating? Okay, let us go with the another very important aspect on this. That is the advantages of the credit rating system. So what are the advantages of the credit rating system? That is, what is credit rating? What are the advantages of credit rating? That is a very, very essential question in the unit number 14. So what are the advantages of credit rating? Advantages are there to the investor. Advantages are there to the company. Advantages are there to the intermediary. What are the various advantages that we will discuss now? So this is in the page number 188, paragraph number 14.7. If you have the material book with you, refer to the material book, and then you can understand how detailedly we are explaining, then how better you are able to understand the various aspects on this. Advantages to the investors, that is safety of investment. So once the credit rating is there, we can assume that safety of investment is there. Recognition of risk and return. Second important one, recognition of risk and recognition of investment process. Freedom for the investment, freedom of investment decision. Investment decision is open, whether you buy or sell, but information only will be provided. Dependable credibility of the issuer. Suppose whether the company will repay me or not, whether the interest will be paid properly or not, all these things we need not worry, because when once credit rating is there, just like ISI mark on the physical products, then the credit rating is also a mark on the issuer. Easy understanding of investment proposal, then relief from botherization to know about the company. When once credit rating is done, we need not worry about what is the company, how it will be, what it will be. All this is need not required. We can rely upon the company if a credit rating is there. Advantages of continuous monitoring will be there by the credit rating agency. These are the various advantages to the credit rating. To the basically investor. Investor is the person, remember, investor is the person who is providing money to the company, not from the company, to the company. I am investing in a company. That is, I am an investor. Then advantages of rating to the company. So company also will enjoy certain ratings on this. So easy to raise resources. If you are a company, if your bonds are rated by the credit rating agency as A+++, then definitely your bonds will be purchased by the open market in a good manner. Reduce the cost of borrowing. You need not pay more and more money for the purpose of borrowing the money. Then relative facilities to growth and recognition to the unknown companies also will be there. These are the various advantages of it. Advantages of rating to the intermediaries also. And intermediaries also have a very good popularity in this. So all these aspects that you have to understand about the credit rating agencies and all. So in frank, this particular 14th and 15th lesson are very, very important in the block number 3. And what are the various methods are there? This is all concerned and services of care, so on and so forth. And lastly, total 15 lessons are made out. And in the 14th lesson, what we have understood about credit rating aspects and so on. And then lastly, credit rating agencies are there and how the credit rating will be done. That is one point I am setting out. So, yeah. What are the credit rating agencies? Give a brief note on credit rating agencies in India. That is an important element. Share. What are the various credit rating agencies in India? So, CRISIL is one, then ICRA, then CARE, DCR, ONICRA, SMERA, and BWR. These are the various credit rating agencies. So what are the functions of credit rating agencies? This is a very, very, very important question for the examination point of view also. What are the functions of the credit rating agencies? This is paragraph number 15.3. Paragraph number 15.3, page number, it is 197. So business analysis is done and evaluation of industrial risks, market positioning of the company within industry, operating efficiency, legal position in terms of the prospects, financial analysis based on account quality, statement of profit, and finally earning protection. These are the various aspects that nearly 17 points are given in that. Out of that, you remember very few and then you can. So what are the highest safety is given symbol by AAA, then CRISIL already AAA, and then CRISIL AA, and high safety, adequate safety, CRISIL A, like that. CRISIL BBB, CRISIL B, CRISIL B, CRISIL C, CRISIL D. CRISIL D means it is default. That means you are not supposed to buy. Then CRISIL C is high risky from the investor point of view. And highly safety, that is represented by CRISIL AAA. These are the various aspects that you have to understand. Then, to conclude upon these classes, I thank all of you for following the class. I hope YouTube you will be able to understand. But the subject financial services is a very, very important subject in various other aspects also. Either you do MCOM or you do MBA, this subject is there in almost all. Financial markets and services, financial systems and services. Like that in almost all PG courses, you will come across this one. So out of all 1, 2, 3, 4, 5 blocks, if you follow any of all the 5 blocks, two concepts, that thoroughly you will be able to understand good knowledge on that. I request all of you to follow well. And if you have any doubts, always welcome. Most of the students also are having. And Shajira, I hope you are able to follow. Shajira. Shajiha Malik. Okay. Anybody else? Thank you. Thank you for your understanding all the concepts. Bye.